All right. Hi, everyone. Hi, this is Mike Marleau from MSP Talk. And I'm excited to have a new guest on board. And for on MSP Talk, the show where we talk about all things scalability within the MSP world. So I'm pleased to introduce Reed Warren from IT Valuations. Reed, how you doing?
Hey, doing well, Michael. It's great to connect with you guys. I've loved the work that you guys have done there at MicroAge, and it's been, again, just great information that you guys have been providing to the MSP channel, especially in Canada. And so love what you guys are doing. You guys are doing some really awesome work. Really appreciate it.
Thanks.
It
Thanks
actually
for the.
makes my job easier. The better the MSP marketplace understands M&A and what drives value, the better off, quite candidly, everybody is down the road. So again, great work.
All right, thanks. No, thanks a lot. So no, this is great. This I love being able to jump on board such a forum like MSP Talk to be able to talk about this subject, about this with you. We first, just real quick, I first met Reed last year in Chicago. I think September, something like
Yep.
that. The big conference, which was for some reason was canceled this year, uh, with the guys at Taylor Business Group. Kudos and a
Yes.
shout out to everyone there. And we're Reed had a couple. You had a couple of presentations on M&As, on preparing your business for resale and everything, and it really it opened up a whole different dimension to how to view such transactions, right? And it so happens that for some reasons that we're going to talk about, it's been booming, right?
Right.
How's business?
Well, business for us has been great, but and I think as we look at, obviously nobody anticipated COVID this year as we came into the year. A lot of interesting impacts. I don't want to say fallout because it's really been an impact in a lot of different directions. One is just in the marketplace. IT services firms have done better than most industries, if not,
True.
the top 3 industries, 5 industries in the U.S. And just as a general rule. And so as a result of that, we've just seen a massive shift by private equity firms and others to, hey, they want to put their money on winning industries and not on losing ones. And so it's just been really amazing here this fall, or Q3 especially.
Yeah.
So many firms just jumped in and so, okay, we need to acquire in this space. So, last January and February, we were seeing an uptick. We were seeing more buyers than sellers. For a lot of different reasons. And then as we came through COVID, I really kind of expected it to balance a bit and there would be more sellers.
Okay.
But the reality is that with the strength of the IT industry as a whole,
Yeah.
We've seen that a lot of investors are trying to find a safe haven for their money, and then IT is about as safe a haven as you're going to be able to get in the marketplace. And so we see actually more buyers now than we did back in January. So that's just one of the interesting side notes. So from an acquisition perspective, really a hot market, a lot of buyers in it, a lot of private equity as well as strategics.
Well, with that many buyers also available, it also drives the price. Drives maybe there's more interest, and if there's more buyers, obviously, there's more bigger. Some guys are able to get out, and they're able to have bigger transactions based on that, right?
Yeah, absolutely. And we do see a fair number, particularly in the. And I don't mean this in any demeaning way, but the smaller MSPs that have been there, just kind of realizing a lot of in the sub $5 million space, especially, just going, it's scale makes a difference when you have downturns in the market, right? Although the industry as a whole has done pretty well, I would say probably a third of the MSPs that I've talked with and that we work with have seen a bit of a downturn. I would say about a third are level to slightly above, and about a third are growing well through it. And again, I think a lot of that has to do with your organic growth strategy that you had at the beginning. If you were just kind of mostly responding to customers and not actually, having a strong organic strategy to grow it, you kind of just rode whatever customer base you had, right? Those that had a good organic strategy have done well because they've been able to continue to penetrate even in a down market and onboard new customers in light of the challenge of onboarding new customers in the middle of COVID. So.
Yeah, it was a whole different ball of wax, and the thing is, it's everybody was waiting for the everything to subside and go back to normal. Hey, you know what? It is what it is. It's not necessarily going to be back to the same normal. However, I mean, the word's out. it's a thriving industry, right?
Right.
And so what we're going to talk about today real quick is I want to go over a few elements, and one of them being the motivating factors. Right now we touched base, you talked about it,
Right.
but specifically eventually we're going to get a bit more towards the smaller acquisition size, right? Because
Sure.
we're always talking about mergers and acquisitions, these huge players, private equity funds getting in, companies getting in to buy these solutions, the cloud-based solutions and everything. And I want to be able to get to the part where smaller MSPs, smaller VARs, and MSPs that are either looking to sell, they're looking to grow their business, but it's hard. It's a hard proposition. Customer acquisition is hard. So, what are the key motivating factors for that segment? Let's talk basically below $3 million, below $2 million, and stuff like that. What are the key factors or the key elements at play?
Well, I think that same thing was true even if we looked a year ago, but it's only accelerated now, and that is market saturation. So there's just not that many companies right now. We're talking about end user or consumers of managed services right now. There's just not that many that aren't using somebody, right? They either have their own internal team or they're using one of your competitors, right? And so the point right now from a market saturation is you can continue to bang your head on the organic growth strategy, which you still need to have. So don't say you don't need it. But the reality is this: you can either go compete head to head, or you can start buying your competition, or looking at ways to grow through acquisition. And so as a result of it, we just see more and more where if you've got particularly the market, particularly the private equity market, is really looking for platform players that have some size and have some good operational maturity. That are scalable, and then that they can buy in and then bolt in a whole series of smaller firms that don't have that same level of operational maturity, and it's a way to be able to elevate that, right? We see the same thing from a strategic perspective that says, hey, if I am a $5 to $10 million MSP, rather than continuing to fight organically, let's go acquire some of these smaller firms. Now, here in the U.S., what's also exacerbated that, interestingly enough, has been the whole payroll protection program that the SBA rolled out to infuse capital into the small businesses to help them endure the situation. For many of them, they've been effectively been able to reallocate a lot of those funds to be able to go do acquisition. So when we talk about what's motivating it, a lot of what's motivating it is market saturation. The best way to be able to scale and grow is through, easiest way I should say, is through acquisition. And then people have some war chest.
Yeah, but we're going to talk about there's also a risk and reward involved, and you have to do your due diligence, right? But you're right in terms of looking at lead generation. It is hard to basically grow and acquire new customers. It's a challenge. Yes, there are certain, but one thing I'd like to ask you before we even get to the next segment, which is the key elements, is listen, a couple of years ago, traditional VARs were looking at their business, and they realized after years and years, and they had they're selling $3 million, $4 million, $5 million, and they're looking at their business, and it's worth a big fat zero, right? Well, not necessarily worth zero, but you know what I mean. Basically, the margins were low. It was very little recurring revenue, and a few years ago, right? And I somehow get the feeling that a lot of these VARs evolved. They basically increase their recurring revenue, make themselves more valuable, concentrate on processes and all that. But however, I'm seeing that right now, since there's such a demand for growth through acquisition and to be able also to have more footprint, right? Be more customer base. Aren't the tables turned a bit? Where even though you have a VAR that has maybe doesn't have that much recurring revenue, but all of a sudden he's got a workforce, he's got staff, and he's also got customer base that he's probably taken care of for like 15 years, right? 15 to 20 years. How does that tie into let's jump on to the next segment, which is, key elements, right? The key elements to evaluate and look at a transaction. Is that a bit more appealing than it was maybe 5-6 years ago?
Yeah, absolutely. So even we see a number of companies, and we have clients at our VARs, a lot of them are looking to acquire managed services firms to be able to layer that in a cross-sell opportunity, right? Or they're trying to build it themselves. Again, the reality is it's cheaper and less risky to acquire somebody that's already functioning and has the infrastructure than to build it yourself.
Yeah.
And then vice versa, we see larger MSPs buying more of our companies because, again, you have the customer relationships. You've been providing great service, and now it's how do we build this into something that's more. And we'll talk about this a lot in valuations and transactions. The enterprise value of your firm is the customer base, the profits of the firm that are sustainable and transferable, right? And so when we look at product sales, they're not really sustainable, but managed services are very sustainable and much more transferable. And so, but you have a customer relationship there that you can start to build things into. That kind of rolls it into the strategic fit. So I don't want to jump too far ahead on that.
Okay.
But with all the market saturation and the motivations and people trying to find all sorts of ways to make this work, a lot of these fundamentals haven't shifted. And it's first and foremost, when we look about those key elements, it's first and foremost about culture fit. I can't understate this enough. If the cultures don't fit, it's oil and water, and it doesn't matter how much you shake it, it's going to eventually separate again.
Okay.
And so when we talk about cultural fit, it really is, the core values. What is your kind of DNA as a culture? Your business philosophy, customer care, employee care. Those are all kind of things that weave its way into that cultural fit. I think as a short, as a quick barometric test, so to speak, on that is ask yourself the question: would you hire, the individual, right? If you wouldn't hire that CEO and put him in your organization, then the culture of that organization is probably not the right one for you.
Oh, good. It's a litmus test, right?
It is.
Okay.
Because in the end, in most situations, and the ones that we deal with, the seller is going to stay on for usually a 1 to 3 year period. As a minimum.
That's the average?
I would say it's pretty rare to see less than 1 year. And they have to be pretty well structured where there's not a lot of risk to them disappearing for them to stay 1 year. Most of the time, especially in the sub $2 million, sub $1.5 million space, the CEO is the glue that holds the customers to the organization. And most of the processes are in his head. The relationships are with him personally or him or her personally. And as a result, you got to keep that individual on for a 3 year period to be able to transfer those relationships effectively to other people. Okay. And so as a result of that, now and this is just a challenge for a lot of the sellers. They haven't worked for somebody in a long time, and that's an emotional issue they've got to work through. But then from a buyer's perspective, you got to be able to have a good ongoing relationship with them. And so again, that's where that litmus test of would you hire them is a good test of, hey, can I work with them for the next 3 years, or am I going to pull my hair out?
All right, no, that's it. Well, it has to do with the maturity, looking at a transaction and being very disconnected. Take the guessing out of it and say, okay, break it down to: would I actually hire that person? Would he actually fit my culture?
Right.
But you know what? Sometimes you can work around it, but I'm pretty sure that's probably a big one, right?
Yeah, it's tough. I mean, I think of it in the well, I'll skip the contrast or the comparison to marriage because
don't go there.
Another one. Yeah, don't go there. But that said, you really got to be able to look at it and say, hey, can I really run 3 years effectively or longer effectively with this individual? And it's not that. Hey, I don't even agree with myself all the time, so I understand that I'm not talking about 100% agreement. No. I'm just saying, hey, from a integrity core value perspective, do you have the same philosophy and approach? And if you do, you'll be able to work through any of the disagreements. But if you really have, where we see it is just we'll often see it between strong sales driven organizations versus engineering driven organizations, right? And you just have the typical fear of a sales guy is he'll sell whatever you need to get the business, right? And that creates a lot of clash with an engineering centric organization. And so that's a classic place where it just breeds further and further distrust, and it becomes more and more strained. Not that you can't acquire great salespeople in the process, but it does come down to a lot of those I can call them again cultural values, core values. Okay. The second one is really. This is where I think the biggest impact is, and that strategic fit.
Yep.
That the first one, you can get along with the person for the next 3 years, fine. Then the next one is strategic. Can 1 + 1 = 3? Is there's enough cross-selling, upselling opportunity? And that's some of the, we were talking earlier about VARs. That's one of the places where there can be a lot of great synergies with VARs, where it's like, hey, we have a customer base here that could be 125 customers strong that doesn't have a strong managed services presence. We can walk in with a strong managed services presence because of the relationships and displace, what's the competition that's there. And so that's an example of 1 + 1 = 3, or greater than 2. And then there's others, whether it's layering in VoIP or cybersecurity services or other services that that are different between the two organizations.
So if we look at culture fit versus strategic fit, the best good analogy is to say if they have the similar culture as yours, however, your strengths, your different strengths, complement each other. Where if you're offering the same services the same way, sure, okay, maybe that can be packaging makes it easy. But if you're looking to really double down on the transaction, is to actually have a company that's going to have strengths, places where you're weak, you're able to complement yourselves.
Yeah, absolutely. So a 1 + 1 = 2 scenario is, hey, we sell the same services, we have the same operation approaches, we use the same tools, and we're going to consolidate out, some of the back office stuff. That's a 1 + 1 = 2, or maybe 2.2 or something like that. It's small, right? It's incremental. There is some consolidation effects. Bigger is a little bit better, and for a lot of reasons, right? But where you get to the 3 or greater than 3, it really comes to start to say, hey, you have strength, you have services that you're really good in that we currently don't have. We see this a lot right now with kind of the cybersecurity related managed services or cyber services. And so we have MSPs that don't have a strong play there, who are acquiring companies that have a strong play there. And again, now all of a sudden you can double that cybersecurity practice overnight, because you have a whole customer base that currently doesn't really have it. And you can build it into the managed service or the subscription pricing that you have, and get that 1 + 1 = 3. And so again, there can be a number of different factors.
Different scenarios.
We've seen it get higher certainly higher than 3. But that kind of reason for bringing that up is if you don't have a 1 + 1 greater than 2, it's almost impossible to make the financial structure work, because the seller's going to go, hey, you're not bringing any real value to this equation. Yeah, we might get a little bit of consolidation lift, but typically a seller's not going to sell for and we kind of get into this on the next one. The buyer's looking for a rate of return, right? I want to get my money back in a reasonable period of time, and I need to get it back at a rate better than the stock market, right? And if I can do that, then I want to make this investment. Otherwise, I'll put my money in the bank or in a mutual fund that's going to get me a return, right? And so for the buyer, the buyer's looking for a financial rate of return, usually greater than 20%. Now if you do the math, that's a 5x multiple. So is a seller going to sell for 5x their trailing 12 months EBITDA? Maybe, but probably not, right? The seller's looking ideally for something that's going to be 6 or 7 or something greater than that. The question is, how can we get the two together? The only way we can get those two to come together, where you have a seller getting a premium multiple and the buyer getting a great rate of return, has everything to do with the strategic fit. And so a lot of what we do, and you guys can do this work in the sub $1.5 million space, is really take a look at, hey, if we cross sell and if we upsell and if we do some consolidation, as a buyer, can I get to a rate of return that's ideally 25 or 30%, which would put me to get my money back in 2 years, or even as short, or 4 years, or maybe as short as 3 years. And at the same time, the seller going, hey, this is a great deal. I got a 6x multiple, right? Both parties have effectively won. The seller got a premium, the buyer got a great rate of return, and everybody is won from a financial perspective, but it's totally contingent upon the strategic fit for the financial fit to work.
And I would figure that it ties into the last piece, which is very important, is that if all those pieces fit, right, culture fit, strategic, financial, it all looks good on paper, but then it comes down to the post-merger integration. How are you going to be able to, first off, you can spend a year to get everybody to work together properly, or if you do your stuff right, if you do it right, you can spend 2 months, but it makes a huge difference in the rate of return, right?
Right.
And would you say that's on the buyer's head? That's on his responsibility. It all usually has to do with the buyer not doing his due diligence or not preparing enough.
Yeah, it really does fall on the buyer's head for post-merger integration. I know so much of it, quite candidly, and this is just normal. The seller's going to have a number of fears, right? And I use this example quite a bit. It's pretty extreme, but the seller's going to go, hey, they think of it in the context of selling a house or a car. So right,
Yeah.
I sold my car to you, you bought my car. There's nothing stopping you once you buy the car from me of taking a hammer to it and beating the hell out of it, right?
Yep.
The reality is it doesn't happen very often. Buyers usually don't beat up this thing they just bought, right? But there is a natural fear, and so I would just say it really follows the whole post-merger integration, the whole success, and really the most critical factor to a successful transaction is about item number 4, which is post-merger integration planning. And you got to really, wish is not a plan. And we go through it. Everybody can get excited at the beginning about all the synergies and how we can harvest that. But if you don't have a tactical plan of how you're going to integrate, how you're going to work together, it just doesn't work. If the location is the mantra for real estate, communicate is the mantra for post-merger integration. And I know it seems really blatantly obvious, but I can't overstate it. And
no, I understand. Definitely.
You got to communicate the future so that people feel comfortable. It's like, okay, they know where they're going. They're not. If you come in and say nothing's going to change, nobody believes you.
No.
And so you got to be able to say, here is what's going to change, and here's how it's going to change. And they're like, okay, I can get on board with that. And then you're communicating the present to say, hey, this is what we're doing now, right? So that's where we're going. This is what we're doing now. And then the last part, communicate the past to build trust. Like, hey, this is what we've done. This is how we've built it, put it together. This is how it's better as a result of it. And so you really have to have, we look at integration. It's not just technical. It's operations. It's sales. It's marketing. It's about getting all of these people with the eye on the future, and they're all pulling in the same direction. Thinking of a rowing analogy, you got to have everybody pulling on the oars at the right time for that boat to go straight.
I bring me to one point. Basically, think about it. Like a lot of MSPs are running lean. Okay, a lot of VARs are running lean. I mean, it's hard to get good people. A lot of companies right now are not growing as fast as they could be, simply because of resources, right? And if you merge these two companies together, and within the first 2 months or 3 months, you actually lose 2 key employees or 3 key employees, not even key employees, just resources that normally were part of that plan. You're basically that you're how do I say it? You're basically making them really hard on yourself.
Right. Well, and it's both sides. So both sides have fears, right? So your current team is going to be concerned about, well, maybe we bought a bunch of great talented people. I'm going to lose my job, right? So both your team and their team will have its normal set of fears, right? And again, a lot of this is just sitting down with the leadership, the buyer and seller leadership, and saying, okay, how do we do this, and how do we build each other up, right? And so as you have delivery people that you may have some really great tier 3 level support people on the seller's end, and that may be a growth area on the buyer's end as just an example. So but it's really sitting down with your team and with their team and say, hey, how are we better together as one? How do we work together without in a non-threatening way?
And this is central to everything, because as soon as let's say, for example, you go to the due diligence, you're ready to sign the paper, you're ready to talk to the employees. It's a plan in place that says yes, you announce it to the employees, but then you communicate what it does to their benefits and why you're doing it. But then there's also the customer base, right? Can't be too disruptive on the customer aspect. So it becomes does it become kind of like a how do I say it? I know I have the French word, but I can't communicate right now. Like a lune de miel, like a honeymoon, basically with your customers. You're wining and dining your customers just to make sure that they get the message that this is going to be very valuable to them.
Right. And I would just say, obviously customer transition is a critical one in post-merger integration. I'll just tell you though, having done a lot of transactions, customers will generally give you the benefit of the doubt. For them, service is probably only going to get better because you got more people, less dependent on one or a smaller group to do it. And so I would say, if you have a situation, we see it quite a bit where we have customers of the seller particularly that are like, I was thinking about leaving, I wasn't really happy, but I heard about the transaction. We'll see how it goes, right?
Okay.
They may, there is a risk they may still leave, but for the most part, in a worst
Okay.
case scenario, they'll give you the benefit of the doubt,
Okay.
because it's way easier.
It's positive. Well, of course.
Well, it is, and the pain to change is massive, right? So
Yeah.
yes, can I
Well,
go
the same reason why customer acquisition is so hard and so challenging right now, the same reason why they will give you the benefit of the doubt. You have to screw up. You basically have to screw up for them to walk away.
Right.
Right.
Well,
Hey,
and
listen.
they're not gonna leave over a minor change in price, because
Yeah.
again, the
Yeah.
cost of change is really expensive. So it's not only just an expensive cost, it's also a massive disruption to the end user of trying to switch from one provider to the next. We just, as a company, just switched ours, and it's like, I don't want to do that again. It'll take this current provider, and they're really going to have to, really stumble bad for us to go, hey, we're going to leave over it, right?
Yeah.
And so the same thing's true. And I would just say the customers tend to be more tolerant than everybody expects. Nobody really ups and leaves. And again, you're going to have to really
Screw up.
really stumble on it and really screw up for the customers to go, okay, it's worth the pain to go shift to it.
Real quick, I got a question. Somebody said, by the way, if anybody has any questions, chime in, use the chat box. I'll put it up on the screen. In this particular case, how long should it take to pay for a business? If I buy a company for $1 million, I should pay it in X years. I mean, I'm sure you've got so many freaking variables that you're asking yourself that go into the equation, but can you address that question a bit?
Yeah, absolutely. So the first piece is just, it really comes down to rate of return. And so when we talk about a 20% rate of return, you're looking at a 5 years, right? I'm getting all my money back within 5 years. And again, so when you look at it from, hey, could I invest the money in the market? Obviously depends on your risk profile. Buying a company is riskier than investing in Apple, certainly, or one of the other markets. But the point is this: it is about a rate of return and the general expectancy. I'll just tell you, as an M&A advisor, if you're not getting a 20% rate of return on your investment from an acquisition, you shouldn't be doing the acquisition. It's just there's too many risks. You're better off putting your money somewhere else. Usually, what we try to shoot for is a 25%. That's a 4-year return. But again, the only way to get to that 4-year return is you got to start having some synergies and strategic impacts to get there. The ones that are the most fun to work on, quite candidly, are the ones where we're looking at, and I've been a part of a number of them, where you're getting 7 to 9x multiples to the seller, and you're getting 30 to 33% return for the buyer, and that's a 3-year return on the money. And
everybody's got a smile on their face, right?
Everybody does it. And so as much as, and I just want to touch on it, because what big way that works is having an earnout. And 93% of all transactions in the MSP space are going to have an earnout, and it should be tied typically to gross margin or to reoccurring revenue type models. And I'm not going to go into the levers on that. We can do that in another conversation. But the point is this: that 76% of the time, earnouts pay out at or above expected performance levels. And so when you start getting to the place where you have a lot of strategic synergies that are going to get you that 1 + 1 = 3, that is how the buyer can pay a 9x multiple on a business, and that's how the seller, the buyer, is also going to receive a 33% return or a 3-year return on their investment. And in that situation, you have both parties pulling hard on the oars. To make sure that gets realized, the buyer. And so as much as there's sellers have a fear of like, well, the buyer is just not going to want to pay this earnout, and they're going to work against me. Hey, it actually doesn't work that way. The only way the buyer gets to their return is be wildly successful. The faster and more successful it is, the better it is for the buyer. And the faster and more successful it is, the better it is for the seller. And that's really the scenario you want to create in an earnout, so that everybody really, it's a financial incentive so that everybody wins.
Okay, that's pretty cool. That's going to be, actually, we're going to talk about it towards the end of the segment, maybe in like 15, 20. It's going to be part 2 of this. This thing is going to be about preparation, about like putting the lipstick on and making sure, like preparing for a sale or an acquisition, right? Listen, so actually you just touched on it, the risk versus the risk factor, right? So I think it's a good time to go into the other portion, which is risk versus reward. Right, as you say, there's so many variables at play. There's so many different aspects, and all these have an incidence on the value of the transaction and reward, and also on the risk factor, being able to minimize the risk and everything. So I've got this slide they put up real quick about on this aspect, and maybe dive into the risk versus reward, mainly probably in smaller acquisitions, because I'm pretty sure.
Right.
Real quick, I can ask you, like, what's the typical size of an acquisition where someone calls upon IT Valuations, where it makes sense for them to reach out to you? Like,
Yeah, well, it's a really good question, and this is something that we help our clients work through, and I'll be candid with it as well. For us to engage, a buyer should calculate the cost of your M&A advisor and legal team into the acquisition costs. That's appropriate and a good thing to do. That said, the minimum fees for us to be able to do the work and to do it effectively, we just have minimums that we have to work with. And we recognize that, particularly as you get under, we've done some in the $1.5 million space. We just got a transaction done at the end of October, or excuse me, at the end of September. That was like 2.2 million. We have another one that's closing here. Crossing my fingers. On Friday, that's about another $2 million transaction. But really, when you get below 1.5 million, it just becomes, you can't get to the rate of return.
Doesn't work. The math doesn't work.
Doesn't work, and I'm not offended by that. It doesn't bother me, but that because certainly want to help people, but I just recognize we don't fit every situation.
Sure.
The challenge is when we look at risk versus reward. As much as you will pay a premium for a well-organized organizations whose financials are aligned to GAAP and they have more operational maturity, those sellers are going to see a premium. What you're going to see is there's a much lower risk. I can calculate the risk. I can calculate the return. I know what I'm getting into. I know how I'm going to make it work. Those kinds of things work out. And as a result, you're going to pay more. But what I'll just tell you, because it happens like just about every time, although you've paid more, you get to your return and you meet your financial objectives and the strategic objectives of the acquisition.
Okay.
Conversely, what happens, the smaller the organization is, usually the less operationally mature it is, usually the more it's built upon, hey, the
owners,
the owners, he's sold everything, and they've got Steve, the phenomenal technical guy. I don't know how he does it. He just works miracles and everybody's happy, right? And
so it's not scalable at that size. I mean, listen,
right,
below 5, 6, 7 employees, there's something about scalability.
Right.
It's hard. It's hard to, I don't know, a lot of power, not a power, but a lot of the success of the company at that size is on the individuals themselves more than the processes and the maturity of the processes they have, right? Yeah,
absolutely. And so what happens with that is you end up with let me back up a bit. So if you can have great people, and if great people are doing things well, you can still get to a very calculated rate of return. The challenge becomes more when they don't have processes. We don't really know how they do it. Their financials aren't well structured and organized. They're kind of in a coffee can. And then it becomes really hard to calculate what the risk is because there's so many unknowns. And what happens, and I'll just, because we see a lot of companies go, hey, well, it was a great buy, They were a $1 million firm at 100,000 EBITDA, and so I got a great deal. I'm just going to tell you, by the time you fix it up and you put the structure in and you get things organized and you get the financials, you'll have spent more on the total cost of the transaction than if you'd bought somebody that was producing at a $200,000 profitability, right? Because they start to get to a better method and approach for how to drive money. And so we see that as you get closer to, as a company grows, by simple nature, it has to become less dependent on one individual to really drive it, and you start to have more people involved and better operational maturity. And so I'll just tell you, the safest companies and usually the most profitable ones are the ones that are really the most operationally mature. You're going to pay more for them, but they have a whole lot less risk. If you like the risk, you can always, you can buy something that's broken and fix it. But it's kind of like, doing a flipping house, right? You're going to buy it, and then you're going to gut it, and then you're going to hope it all works out, and you hope there's no really big surprises. And the place isn't eaten by termites or whatever, right? And so, there's a lot of things right there that you just can't quite fully calculate in advance. But
Okay.
there's a place for that. I would just say most people, when it comes to business, don't want any more of the distractions than necessary. And I will just tell you as a general rule, buy the most operationally mature organization you can.
Okay, of course. No, I understand. And but one thing though that everything you're talking about when it comes to like a million dollar company, right? Then all of a sudden I get the feeling that it's a lot more about the possibility of a merger versus an acquisition, right? Like, can you expand on the difference real quick? And also, I have a question from from a user, but I want to dive into that piece, like merger versus acquisition at that size.
Yeah, so a merger is really much more of a coming together of equals. And an acquisition is much more of, hey, we've got operational maturity or whatever, more so, and we're buying you, and we're going to push you, the seller, into the structure of the buyer. We do quite a bit of merger work, and that's, we see a lot. Great case in point is Taylor Business Group. Love those guys. You got a lot of people that have been a part of peers for a long time. The nice thing about being a part of, whether it's Taylor Business Group or Evolve, or even within the micro age community, that just says, hey, you're people of, you have a similar cultural perspective, you have a similar financial perspective, you have similar operational maturity, and it becomes again, from a cultural fit, you can almost check that box immediately. Financials are usually, there's better financial maturity, there's better operational maturity. And so we'll see a lot more of the merger. And although it's not a 1 + 1 = 3, you're able to say, hey, here's a 1 + 1 that clearly equals 2.2, 2.5, and it becomes a low risk merge to come together.
And so at that point, it might actually tie into like a succession plan, and maybe to saying, okay, let's look down the road. This is basically the setting stones, or they're basically like a springboard to be able to put us together so we can actually make a better job or get better.
Yeah, great example. We just got done with we always call phase 1 of the project merits of a merger. We'll do a valuation on both firms, and then we'll quantify, hey, what's the consolidation, what's the cross sell, what's the upsell. In almost every case that we look at a merger and we do the valuations on that, we're seeing typically about a 15% improvement on the value of the converged organization, just with basically just putting the two together, no consolidation. It's getting 20 to 25% increase in value with minor consolidations. Okay, I don't need 2 accountants and I don't need 2 of that, kind of a thing. And it's not like you're whacking staff. It's just hey, we don't need 2 CPAs on the project. We don't need all the same office expenses, right? And then we're typically seeing to a 30 to 35% by the time we include calculate the synergies. And so for most companies going into a merger, you're going to see, putting the 2 companies together, somewhere between 25 and 30% improvement on the converged value of the organization. So the 2 being 30 to 25 to 35% worth more together than apart. And then for a lot of them, it's part of an exit plan. So you've got one of the companies has somebody who's interested in retiring or wants a path to that, right? And so this becomes a way where, hey, I can merge in, find a great home for my organization. We can do a 5-year buyout or something smooth. I've got a job for 5 years. I can help make this thing and leave a good legacy, right? And so it can really work well in those situations. And I would just tell you, almost every merger that we do, we have at least one shareholder or owner looking to strategically exit over a calculated period of time as a result of that, rather than trying to go through being acquired. It's just, I'll tell you this, mergers tend to be less stressful. It tends to be greater relationships, stronger relationships, better peers coming together than, hey, I've got somebody from the outside who really doesn't know my business well and is just going to buy it and hopefully it all works.
Oh, that's, you know what? You just that's actually quite a bit of surprise. I can understand the rationale. I can definitely see it. And all of a sudden, I had this feeling that basically acquisitions tend to happen more. Or be basically like, if I'm selling, unless I have so much emotional attachment to what I'm selling, it becomes more a question of, I had a good run, but the thing is, all of a sudden you're working for somebody else, and it might not work out for another 3 years, maybe a little less than that.
Well, case in point, the one that we're working on now for closing Friday, we have an owner that's 64, and it says, hey, if I try to get ready to sell, so when you think of a firm who wants to get ready to sell, it's usually a 3-year run to get your
Okay.
organization all structured and ready and everything done so you get an optimum value. So either look at a 3-year run, or in this case, is looking at saying, hey, I can kind of merge with this other organization. I can get a fair market value for my firm is today. I get to harvest the upside of somebody who's got more energy to really scale and grow
Yeah.
it. And as a result, I can get to an exit, a reasonable exit in a 3 to 5 year window. I've got a job for the next 3 to 5 years. And then the other big thing is the whole thing's not sitting on my shoulders any longer, right? I've got somebody else that can really help carry that load and share that load, right? And so it's a great win-win all the way around. And the buyer in this case is a friend of the firm, so to speak. They've known each other for a long time. There's great relationship, and we already know culturally it's going to work well. Strategically, there's a lot of good pieces. In the end, I'll just tell you, as much as we work with a lot of lawyers getting transactions done, it still comes down to this is still a very relational business. When we take a company to market and we help them sell, we'll get 3 to 5 kind of offers on the business, and I'll tell you, it's very rarely that the seller's choosing the highest, the biggest number. In the end, what they're really looking for is, hey, where's the one that has the strongest relationship, that have the highest probability of success, where I feel like I'm going to be the safest, right? There's a lot of those emotional attributes that they work through, and in the end, when you have a merger, you have somebody that's coming together where there's already a strong relationship, then you're going to get to your earnout. You're not going to get screwed on the process. And so as a result, there tends to be all those emotional synergies that make for a good transaction.
Okay. All right. So basically, so it's a lot of relationships, like you said. Listen, I have a few people that chimed in real quick. Tony, listen, how you doing, Tony? Been a while. I always see Tony at the Channel Next shows, but haven't gone to one of those in a while. If you're buying, but I think it's more of a statement, right? If you're buying it as an investor, it could be 10 to 20 years as long as the business is leaving you with a profit at the end of each year. Sure. Okay, so basically you're talking about laying out some cash to buy out a company, but basically will benefit you in the long run. But 10 to 20 years, I think that in this day and age, right now, not a lot of investors have that patience. I would say that's my end.
It really depends. I mean, we see like family. So where we see that kind of approach, Tony, is actually with kind of like family funds, where you've got a family fund, they've got 20, who knows how many $1 million, right? Or maybe it's $5 million that they're going to put towards it. And they're really looking at a safe place to put their money that they can harvest, almost kind of like an income fund that you'd have on the stock market, but just done on a business piece. And so we do see those places, and they'll take a long perspective. They'll hold the business for 10 years, 15 years, or sometimes they intend to hold it for life and layer in appropriate leadership when a leadership transition. So, we do see those, and we do see those quite a bit. I would say most of the transactions we're seeing today, especially with PE coming down, is they're really looking at a 3 to 5 year time horizon, and then flipping the whole piece to somebody else. And we can talk about how PE companies make things work, but it really is a different model than what we're seeing in the strategic and most of the acquisitions that we see in that sub $2 million space.
Yeah. Well, as Tony chimed in, so basically the important part is the out-of-pocket cash, right? Yeah. All right.
Yeah. Oh, absolutely. And not to get lost in cost of capital, but here's the reality: you can take your own money that costs you whatever percentage. For most, if you're an MSP provider, your cost of capital. So what does it cost you to generate money out of your own organization? You're looking at typically 17 to 20%. So when you can go borrow money at 5% or 4% or 3.5%, and then go do acquisitions, you're leveraging capital, right? And so I think what Tony's getting there, important part is how much out of pocket you have to put. I'm going to tell you, the less out of pocket you have to put out, the more you can leverage somebody else's money, the better off you're going to be. Yeah,
real quick. Listen, we actually got to sign off pretty soon. But if you look back at the thing there, reasonable deal structure at the end, 30% cash at close, collateral seller note, earn out, and stuff like that. But you know what? I'd love to get into that, but we're basically, I think we're about to run out of time, right? Because this could be basically a rabbit hole, and I'd
Yeah,
love to be able to leave something for the
right.
next part, right? And before we go to the next part, just to let you know, this is a first for us, all right? I have actually Steve. I think if I'm getting right, is there any interest at all buyers for a sub $1 million company? So it's a first. Listen, it's a first for MSP talk. I got Steve that looks like he's going it out there. Hey, listen, anybody want to buy my company or something? So
Yeah, I'll just say this: there's a lot of interest. Again, best way to do it for both buyers and sellers, candidly, is just networking.
yep,
Just get out, meet with people, because in the end, you want to vet that cultural fit. Best way to vet that cultural fit is to
yeah.
meet with the other CEO and go, hey, do I like this guy, or already know right away? We're going to clash, right? And so a lot of that is just build those relationships, then get into a conversation about it.
Actually, you know what, Steve, give me a call. You know what, if I can help you out, and depending on the market you are, I'll definitely put you in touch with someone who might be interested. But it actually goes back to like a micro wage. Basically, what we do is, you mentioned earlier, a lot of buyers and sellers, they meet, it's relationships, right? They meet at peer groups, they meet in the same environment, right? They have commonality, and same thing can be said about micro wage. For the longest time, a lot of franchises, because listen, micro wage used to be with many more locations than we are today. Not that because basically the market evolved that way under Hardco, but there was a lot of owners that would buy each other out, right? There was it was a fit, right? You'd buy another company in another city in another market, right? So the commonality aspect is important. So you're able to know the buyer and seller. They do know each other. There's a level of certain respect. And hence, I can definitely understand why a lot of these transactions happen between members of the same peer group. It's
Right,
just like within microwage.
right,
All right. So listen. Wow, it's pretty cool. Listen, like I said, I wanted to leave some for the next part because this was great. Right. I really love this. Right. And the next part we'll set the date, not determined right away, because I actually do have a webinar on to prepare for in 2 weeks' time. That's got my whole attention. In case you haven't heard, it's the roadmap to profitability,
excellent.
to learn more about the micro age program. And after that, I'll definitely hit the read up so we can set up a date for part 2, where we're going to be diving into more of a preparation, right? Like the steps to be
Right.
taken. So maybe you give like a little cue about what we could be touching base on for that part.
Yeah, there's a lot of elements, and we'll be talking about financial preparation. We'll be talking about operational preparation. We're going to be talking about legal preparation, and then just team preparation. I think when you look at the four main areas that you need to get ready, you need to proactively work in each of those to get the whole organization really ready for a transition and a transaction um, on each of those pieces. So we'll jump in more on that, and likewise, happy to, Mike, anybody that's got questions, happy to, field them as well, because there's a lot of stuff that are just unique situations like that you're in, and you're like, hey, so how do I deal with it here? And
Yeah.
I'm happy to provide commentary to that and help people out as a part of that journey. Not everything's a project, so we're not here to bill you for everything. It's just, hey, a lot of people just need a sounding board and say, I got this call, and should I take it? Should I move forward? And it's like, hey, happy to help you sort that out.
Yeah, no, that's awesome. Listen, I mean, this has been great. Thanks for your time, Reed. This is awesome. And look forward to the next part, and we can dive in. And guys, you know what? If you like this one, give it a like, give it a thumbs up, and maybe prepare some questions for the next one,
Yeah.
right? And submit it in advance if you want. Like, shoot over some questions in advance. We'll put them in there, to the discussion, and really make it as as most valuable as possible. Right?
I love it. Thanks so much for allowing me to be a part of this. Really appreciate it, Mike.
That's awesome. Take care. So, all right, guys. So I'll sign off now. So take care, everyone, and I look forward to the next episode of MSP Talk. Bye bye. And broadcast.